Disclaimer: something just broke in the silver market. Not slowly, not over years, not in a way that shows up cleanly on a chart. It broke inside the system. Because while headlines are celebrating record silver prices, the institutions responsible for keeping this market stable are doing something very different. They're panicking. And when institutions panic, it's never because prices are going up, it's because control is slipping away. Late on a Friday night, after markets closed, when liquidity was gone and attention was low, Shanghai quietly pulled an emergency lever. Rules changed, margins were raised, and the timing alone tells you everything. This wasn't about protecting investors. It wasn't about speculation. It was about fear. In this video, I'm going to show you why Shanghai's silver panic is far worse than markets admit, why this move signals deep structural stress, and why the silver market may already be crossing a point that history shows rarely ends peacefully. This is not financial advice. This is educational analysis based on publicly available information. Let's begin with the number that shattered a 45-year illusion. The price that was never supposed to happen. Silver has just done something it hadn't done since 1980. It destroyed its all-time high. Not tested it, not flirted with it, destroyed it. Silver is now trading in the $61, $64 per ounce range, with recent intraday highs approaching $65. To understand the significance, you need historical context. The previous all-time high, around $49 per ounce, was set during the inflation crisis of 1980. That level survived. The Volcker rate shocked the tech bubble, the 2008 financial crisis, decades of quantitative easing wars, recessions, and currency collapses. For 45 years, silver failed to break through. And now it didn't just break, it exploded past it. Since the start of 2025, silver is up over 110%. That's not a normal bull market. That's not organic appreciation. That's the kind of move you see when structural pressure finally overwhelms suppression. Gold has surged too, up roughly 60%. But silver isn't simply following gold anymore, it's decoupling. The gold to silver ratio has collapsed from above 90 to the mid-60s. Historically, this only happens when silver stops behaving like a financial asset and starts behaving like a scarce industrial input. And that's where the real story begins. Because price isn't the danger, the reaction is. Late Friday evening, the Shanghai Futures Exchange released an emergency notice. Margin requirements on silver futures were raised to 17%. That number may sound technical. It isn't. Margin is how exchanges control risk. It's the lever they pull when volatility threatens stability. Most commodity markets operate comfortably between 5% and 10%. Shanghai was already at 16%, a level that already indicated concern. And yet, they went higher. Over a weekend, without warning, without consultation. That's not routine, that's a fire alarm. Exchanges only move like this when they fear Monday morning could bring something they cannot contain. This wasn't proactive risk management. This was defensive action. They saw accelerating price action. They saw rising delivery pressure. They saw physical demand colliding with paper leverage. And they reacted. By raising margins, exchanges attempt to force liquidations. They make it expensive to hold positions. They try to engineer a paper sell-off. But here's the uncomfortable truth. The playbook only works when physical demand is weak. And right now, physical demand is anything but weak. Why Shanghai matters more than New York. To understand the gravity of this moment, you must understand what Shanghai represents. COMEX in New York is largely a paper market. Most contracts are never delivered. They're rolled, netted, or settled in cash. It's price discovery, but detached from physical reality. Shanghai is different. Shanghai exists to serve real industry. Chinese manufacturers don't trade silver for speculation. They trade silver because their factories cannot operate without it. Solar panels, electric vehicles, semiconductors, medical equipment. Paper contracts don't power factories. Metal does. China is the world's largest industrial consumer of silver. They dominate global solar manufacturing. They lead EV production. And both sectors are expanding aggressively. Each solar panel requires silver paste. Each electric vehicle uses significantly more silver than a traditional combustion vehicle. And here's the critical point. There is no meaningful substitute. Silver has the highest electrical conductivity of any metal. You cannot replace it without sacrificing performance, efficiency, or safety. So when the exchange serving the world's largest physical buyer panics, this isn't speculation overheating. This is supply stress flashing red. And here's the part most people completely miss. The margin hike wasn't designed to solve the problem. It was designed to buy time. Because once physical demand overwhelms paper control, there is no clean exit. Paper control versus physical reality. Raising margins follows a familiar script. Make positions more expensive. Force leverage traders to sell. Create downward pressure on paper prices. On charts, it looks like control. In reality, it accelerates the problem. Factories don't shut down because volatility increased. Solar contracts don't pause because exchanges panic. When prices dip artificially, physical buyers step in. They lock in supply, they front-run shortages, they drain inventories faster. Every attempt to suppress price using paper tools ends up tightening the physical market even more. This is the fatal flaw. Exchanges can create unlimited paper contracts. They cannot create silver bars. When too many claims exist on too little metal, control becomes an illusion. The supply. Deficit that won't go away. According to industry data, the global silver market is facing its 5th consecutive annual deficit. Mine supply has stagnated. New projects take years. Recycling can't fill the gap. Meanwhile, industrial demand keeps climbing. Solar installations are accelerating globally. Electric vehicle production is scaling faster than expected. Electronics demand remains resilient. Silver is unique. It's both an investment metal and an industrial necessity. When investors, manufacturers, and governments compete for the same shrinking supply, price stops being theoretical. It becomes a rationing mechanism, and rationing is never gentle. The next phase, loss of confidence. In the short term, expect volatility, more margin hikes, more intervention, possibly trading halts. Each move will be framed as stability, but each one is actually an admission of weakness. In the medium term, physical premiums rise. Spot prices diverge from reality. Availability tightens, delivery delays increase, and then comes the real risk, confidence erosion. When participants begin questioning whether contracts can be honored with physical metal, trust evaporates quickly. And markets without trust don't unwind calmly. You can't fight physics. Shanghai didn't panic because silver went up. They panicked because silver stopped obeying paper rules. You can change margins. You can halt trading. You can manipulate prices. But you cannot print metal. And right now, the physics of supply and demand are overpowering decades of paper control. This isn't the beginning of the story. It's the moment the system revealed its weakness. Watch the physical market. Because the most important signals aren't coming from charts. They're coming from panic.